For those looking at an exit someday, Fairmount Partners is who you need to hire to help your business grow and have a successful exit. While you're doing that, I didn't introduce myself. I apologize. I'm Ward Kurtzman, co-founder of HR Tech Alliances and founder of HR Tech Advisor, which runs the HR Tech Alliances community platform and events that we have, some for the public, some for members only. Please join and check it out.
Terrific. So let me do a quick introduction. Alan with Fairmount Partners, an investment banking advisory firm. We're based in the Philadelphia area. We cover 4 industry sectors, one of which is technology. The less relevant sectors are healthcare services, industrial consumer, and business services. The business services practice is relevant because we do a lot of deals in the staffing space. We focus on staffing, and then we also focus on technology around staffing with regards to HR tech. This is my team on this slide, and we are very active in the HR tech space. Worklama was a deal that we recently closed. That was a capital raise deal. And then we're active currently in a buy-side arrangement with a company called Energage. And Energage is an employee recognition and survey business based in the Philadelphia area. Mm-hmm. And we're involved in the buy side. We've got one company in talent management that's under letter of intent. And then we're also looking at additional companies as well. So pretty active in the space. We break HR tech into 3 sectors: talent acquisition, talent management, and we call it human capital management, but it really encompasses a lot of the core function, benefits, payroll, things like that. We track about 1,200 companies, have regular conversations with emerging growth technology companies, private equity investors, and public companies in the space. We track metrics, transactions, and trading multiples, which is helpful in understanding when you eventually are thinking about an exit, what can you expect from a valuation perspective? It's always helpful to understand how companies are trading. Adjacent to what we do in HR tech, we also have a SaaS industry update. We're tracking SaaS companies, and a lot of HR tech companies have a SaaS business model. But it's helpful to understand what drives value in a SaaS company, and we have a lot more data points around that, and also what drives value in specific verticals like HR technology. My email's on here. It's alan.bourne@fairmountpartners.com. And if you're interested in getting the SaaS update, the HR tech update, please give a shout, or interested in talking. And also I can be reached on LinkedIn, which might be easier. I keep track of my LinkedIn messages. Most of it's spam, but I do respond. As part of our practice, we try and make our presence felt at a lot of the shows out there. This is my schedule next year. RecFest is coming up in Nashville, 12th and 13th, and the HR Tech Show, which I'll be at as well. And then conference season again starts in the spring with SIA Executive Forum, which is really a staffing company, but there's a lot of technology vendors, particularly that focus on contingent, that are there. Transform, SHRM Talent, Unleash, and the SHRM Annual, which is always a raucous good time. Diving into the market update, we track public companies and we track M&A transactions. From a public company perspective, because HR tech companies do a lot of things, more sense to focus on sizing. There is a clear distinction between large cap public companies trading at about 7 times revenue, and mid-cap public companies, which are trading at about 2 times revenue. The cutoff is $1 billion in revenue. That's the big driver. We'll talk more about those companies later. IPOs, there have been no IPOs over the last year. There are several IPO candidates. We hear about Deal, Gusto, Rippling, Velocity Global. All of them have raised hundreds of millions of dollars. All of them are valued at $1 billion plus. And really, when you hit those valuations, the only real exit is an IPO. Continue to track that, and looking forward to adding names to our public company universe. On the M&A side, last 12 months, M&A valuations were at about 4.1 times revenue, which is pretty consistent with where they've been historically at about 3 to 4. There's been 130 deals over the past year, Two had premium valuations, enterprise value to revenue over 5 times. Valuations are down a bit. We also track VC raises, and I've got more information on that as well. But you can see what's happened with the VC side since Q4 started to tick up. Q4 23 was the low in VC raises. I'll spend more time talking about that and what we're seeing in the VC space. In terms of key trends, AI is super hot, and everyone is launching a co-pilot and utilizing AI across the areas they work. The big thing that we look for in is the company really an AI business? It all comes down to the amount of data you have that you're able to leverage, that you're able to create models. If you've got access to big proprietary data sets, you can make key learnings. So that's what we look for when somebody calls themselves an AI company, right? It's what's the uniqueness of your data? What's the ability to leverage that data to make really interesting observations that may not have been makeable previously? So that's an area that's obviously very, very interesting and hot.
Alan, quick question. How do you think it's helping the evaluations, and is that going to be a longer term thing, or is it a flash in the pan?
No, I think it's real. People have been calling themselves AI and ML companies forever.
Yeah.
People are now seeing the power of AI and what it can really do. Those companies that are leveraging it, there's real value there. I don't think it's a flash in the pan. I don't think it's a fad. I think companies that are really leveraging AI are very well positioned, and there's a ton of interest there. I think it's important, provided that you're really doing it and not just calling yourself an AI.
Yeah, that's what I was wondering. If so, it could hurt the valuation if they're just bullshitting about it.
If you're just bullshitting and saying, yeah, we leverage AI and ML, people are smart enough today to understand what does that mean, right? They're able to ask the
Yeah.
right questions today, whereas really before ChatGPT, people would just be like, oh, okay, you do AI, that's great, without really understanding. People understand now. They'll ask questions and probe. It will become apparent if you have something unique and differentiated or not. If the answer is you don't. So making
Yeah.
boastful claims is not helpful. Plenty of great companies don't have AI
Yeah.
and are worth a lot of money. Own the differentiation. What's special about your business? And if AI isn't part of it, then don't claim it because your business may be strong enough without it. So the labor market is the next point. You hear a lot about tech layoffs, but where the market's really tight is in frontline. It's restaurant workers and people like that, frontline workers, warehouse workers, where the labor market is still very tight. There's interesting mobile-based technology helping frontline workers with payroll and time and attendance. That's an interesting trend. Corporate learning has been and continues to be very interesting. You're seeing a lot of corporate learning focused on skills gaps today. And how do we train the people internally to do the things that we need them to do, right? It's a lot more efficient to hire someone internally than it is to go and post a job ad. And also when you're hiring internally, the retention rates are a lot better, right? They know the organization, they are part of the culture. People are training and growing their internal workforce to take on important roles that they need. On the hybrid side, I think we're sort of moving into a normalized model where people are kind of working 3 days a week in the office. It has taken a while to sort of get normalized, and that's just speaking for our firm as well. I think experimented and tried a bunch of different stuff. And so we've sort of settled on Tuesday through Thursday. And it's still important to find. So why is it important? Well, it's important to find the tools that help people to continue to be collaborative and work together in a remote environment. But also it's important to understand how firms are able to leverage remote workers, to think about how do we hire right? How do we take a hybrid model and make it work, but also maintain flexibility around the workforce. And so this continues to be interesting. I mean, but we still see companies that are 100% virtual today. And really, I think it's awesome, and it's also challenging. It's awesome because you can hire anybody. In Philadelphia, for instance, we always had a sort of a situation where it was really tough to hire people into Philadelphia, right? They'd want to go to New York. And Philly would lose a lot of grads. They want to go to New York, they'd want to go to the West Coast. And so hiring becomes challenging. Now these Philadelphia-based companies can hire anybody anywhere as long as they're talented. You don't have to move to Philadelphia if you don't want to. It's a great city, but you don't have to. The flip side to that is you really, if you're running a remote workforce, and if you have a ton of remote workers, you got to figure out how to create culture and hooks that keep people in the organization, because otherwise they churn. And we experience that at Fairmount. You got to find ways to build culture, and that's super important. And it looks like we have a question. Oh no, that's you, Ward. Disregard.
Sure.
Disregard. And then lastly, the tech layoffs, and it's awful for the people who are getting laid off, but it's an opportunity for people who need to hire tech talent. All righty. This is how we think about the space. So I mentioned the high level categories. This is how we subcategorize it. We talked a little bit about this as well. Here's our market map. And we find we actually try and be good about updating this quarterly, right? Companies come and go, and so we try and be pretty good about understanding what the important subsegment sectors are within each high level organization, and who the companies are that compete in those subsectors. We do have. I don't think I'm going to spend a ton of time on this, because I think I'm happy to share the report and people can read it. Talent acquisition has been tough over the last, call it, year or so, and I think it's really related to. I mean, you're seeing it in jobless claims. Your companies have been slow to hire, and you're seeing it there's weakening in the employment rate. Again, frontline workers aside, but I think it's been somewhat of a struggle in 2023 and 2024 for companies that are focused on the talent acquisition space. But there are groups out there that have been really helpful, and they're differentiated. So it's been tough for some, but if you've got a really unique offering and a really differentiated offering, it's been better. I'll talk a little bit about Monster and Career Builder in a second. Talent management, we talked about corporate e-learning. You see the market there. It's very important, very relevant. And again, addressing skills gaps is something that we're seeing a lot of. And on the core side, this has been where all the investment has been over the course of the last year, right? Rippling raised $200 million, Factorial home-based. When you look at the venture money flowing into HR tech, a lot of it's in core. And the reason is because core and payroll benefits, HRAS, compensation, these are needs to have, not nice to have. And so when we think about where opportunities are, are you a need to have? Are you a top 3 pain point in an organization? If you are, that drives interest, it drives activity, it drives valuation. All right, so let's talk a little bit about where we are from a capital markets perspective. So this is a little bit outdated. I've got a footnote down at the bottom that talks about where we are today. But in June, the CPI fell back to 3% from 3.5%. It had been hovering above 3.5, it was 3.4 in December. So the Fed's target rate is 2%, right? That's the level of economic growth that the Fed is comfortable at and deems as, if it's 2% or under, we are not in an inflationary environment, right? So it fell to 3%. And on a monthly basis, you can see that in May, the economy grew, the CPI grew 0.0%, so it didn't grow in May. It declined in June. The July numbers come out, I think, in the next couple of days. I think they come out later this week. So clearly inflation is getting under control. On hiring, so you've seen sort of a weakening of the labor market. And so when the Fed is looking at, okay, do we have inflation under control? It's how hot's the economy? How hot is job growth? Those are two of the big things that they're looking at. So we just talked about the economy. On the job growth front, so in June, non-farm payrolls increased by 200 grand. In July, where you see my little footnote here, they actually edged up 100, so it's 114,000. And this is down from 300,000 in March. And so you can see that job growth is slowing. And the unemployment rate was 4.1% in June, but the recent numbers came in at 4.3%. And it triggered something called the SOM rule. And when I send this out, I'll put a little footnote or a little link to where you can find about the SOM rule. But basically, it's an indicator it's a recessionary indicator, and it has to do with how fast the unemployment rate is growing relative to how it grew historically. So the SOM rule was triggered, I guess, last week. We had a huge sell-off, but the market has recovered. And I think that there's a whole lot of other things going on. So yes, it's a recessionary indicator, but there's a whole lot of other things going on. You had issues going on in Japan. Japan just raised interest rates. There are some other things, and the market has since calmed down. So we're not ready to say yet that we're heading into a recession. We are still hopeful that the Fed is going to engineer a soft landing, which it has basically never been able to do. But we see with the companies that we talk to, with the buyers, the large companies that we talk to, positive signs. And those positive signs are the backlog is filling, the pipeline is filling. Corporate buyers are buying software again. They had stopped buying software for a while. And so we're having more conversations. We are pitching more. So the activity is ramping up from our perspective, and what we expect second half of the year. Well, we're already in the second half of the year. Kind of post Labor Day, you'll start to see more companies come to market. There's some people will ask, well, what about the election? Do you think everybody's going to wait to see what goes on with the election? I don't. I feel like the election is kind of priced into the market. People know what to expect generally from a business perspective from a Trump administration. They have a pretty good sense of what to expect. Certainly, they had a good sense of what to expect from a Biden administration, and likely from a Harris administration as well. So I think a lot of that is priced in. I don't think anybody's going to wait until the election to see what happens. In terms of rate cuts, so we're still at 5.5%, and we have been since the end of the year. The Fed had previously signaled 3 rate cuts for 24, but the Fed has held off. We're now projecting a very high probability of rate cuts in September. And some folks are saying there may be as many as 6 rate cuts now between now and the end of the year. There are indications that the Fed may seek to, and this is another footnote, move rates closer to neutral, which is if we're at 5.5%, neutral is around 3.5%. I mean, remember years ago they were at 0, but potential to move them to 3.5% by the end of the year. That should open up more lending, and I think it will open up more deals. Also have thoughts on the equity markets. So Q2 was down from the S&P. I mean, it rose, but it didn't. Q4 and Q1 were really hot, both for the S&P and the NASDAQ. The growth has tapered a little bit of uncertainty and a little bit of jitteriness in the market, as is evident by what happened previously. And then on the debt market side, and we track this because it drives big M&A. It's less impactful on small M&A, but the ability to access reasonably priced debt is important as for private equity groups, and it's important for corporate buyers as well. The ability to raise debt at reasonable rates. I'll pause there for a second and just see if there's any questions, because I went through a bunch.
Alan, that was good stuff. I don't see any in the chat at the moment if somebody
Okay. All right.
wants to, but my question is, you covered a lot about the different drivers of the economy and so forth. If, let's say, most people that attend our events tend to be in the talent acquisition technology
Yep.
space, and just wondering which one of those should they be concerned about the most? Obviously, they should hire you to have as an advisor, and you can just tell them. But if you could dish a little bit on that in terms of what tends to drive that more, is it the unemployment or that kind of those kind of metrics?
The way to think about how companies are valued, or what drives value in a SaaS company and what drives value in a HR tech company, it's really three things. So I'll turn to M&A here in a little bit, but it's, are you growing? Do you have size? Do you have critical mass? And are you cash flow positive, or do you have the ability to be cash flow positive as well in the near future? So if you're a talent acquisition business that's flat from a revenue perspective, but your pipeline's filling, you're increasing your bookings, that's a sign of momentum. So what do we look for? We look for signs of momentum. Actual momentum is better than signs of momentum, but signs of momentum is still good. We look for that. We look for companies sort of $5 million plus in ARR with the ability to grow to 10. That's important. And the ability to get cash flow positive in a reasonable amount of time is important as well, because today's strategic buyers do not want to fill cash flow holes. And so I think most companies have done a really good job of trimming costs, most emerging growth technology companies, because VCs are being very picky about the companies that they're supporting. And so they're focused on supporting the companies that are continuing to grow and the ones that they think are winners. If a portfolio company has stumbled, they're tending to be less interested in supporting those organizations. So the point is that there's not a lot of money out there from the venture side. And so you really need a cost structure that'll allow you to get to a point where you can be cash flow positive. And maybe it's due to synergies, and maybe it's within an acquisition. Those are the big things that are focused on. So if you're in talent acquisition, which is an area that by and large is having a harder time than, say, core, if you're still growing, then people are going to be excited about investing in you, and they're going to be excited about M&A. So I kind of look at these fundamentals as opposed to what specific vertical are you in, because the interest level, the uniqueness of you may be able to drive growth in a vertical that is lagging other verticals, if that makes sense.
Yeah. Well, then, right. If your customers' subscriptions are going down or whatever, they've got to look at diversifying or something to,
right,
like you say, get to cash flow positive and leverage what they got.
Yeah, well, I'll blow through this, but here's where multiples have been. You can see in 2021, both on the large cap side and on the mid cap side, you had this rapid rise that was COVID related. They have since sort of traded in line with where they had been pre-COVID, with a little bit of weakness recently in the mid cap space. And so you see that as well. I won't spend too much time on that. This is where they're trading. This is kind of interesting. When you look at percentage of 52-week high, the large caps, with the exception of Paycom, a lot of them are trading pretty close to 52-week highs, not the same for the mid cap. So DHI at 50%, Upland at 47%, Paycom at 46%, Freshworks at 50%, right? So they've struggled a little bit. All right, moving on to M&A. We track who are out there doing the deals. This is sort of our top 10 list and the numbers of deals that they've done since 2017. So we want to stay close to these guys and understand what their approach is on M&A, what it is that they're looking for, so that we can communicate that to our companies and to our clients and our prospects and the market in general about, hey, here's UKG's strategy, or here's ISIM's strategy.
Alan, real quick question on that.
Yep.
Just scanning through this, a lot of those look like they're private equity owned. Is that a recent trend, or do you expect that to happen more on most activity levels? Is that who's driving?
That's a good question. So PE, right? And you've got Beeline is private equity backed, and they're going to be on later. PE is focused on how do we effectuate growth. And there's two ways to do that. One is organic growth, and then the other is through M&A. And so M&A becomes a tool, right? So taking a step back, private equity company buys a platform company. They may buy a flat platform company that's doing $100 million in revenue. So they get return by doing a couple of things. One is they'll borrow and then they'll pay off the debt. So they get return based on that. But they also get return by growing the business, and bigger businesses see multiple expansion. So if a $100 million is probably not a good example, but let's say they buy a $25 million company and grow it to a $50 million company, a $50 million company is going to trade at a higher multiple. And actually, it's right here. It's going to typically trade at a higher multiple than a smaller company, right? And so we don't have a lot of data, right, particularly over the last 12 months. But in general, you see multiple expansion as you become a larger company, right? So M&A becomes a very good way to grow a business, take out a bunch of costs, grow profitability, and ultimately, why do you do M&A? You do M&A to create a return for the private equity group.
Yeah, and Alan, on behalf of the HR Tech Alliances members, a lot of them are in the alliance and partnership role, and their goal is to partner with a lot of these companies. And as you know, thankfully, some of them date before they get married and before they do the acquisition, right? So becoming a partner can be a double benefit there if you're looking at exit at some point.
You are
And
exactly right. You're exactly right. So UKG is a good example of that. Workday is a really good example of that. You get into the ecosystem and become partners with them, and they're able to leverage your tech. They're able to introduce you to their customers, and it's a good way for them to see which partners have good uplift and what can happen. And when you've seen it with Workday and with others, is that they see a really great opportunity and they see really great business, and they decide, look, our customers love it. It fills a hole that we don't have. We want to make sure that nobody else has it. And so a Workday will buy a Pecan at a really big valuation. This is mid-COVID, so we're not seeing those valuations today. But you get into their system and you become strategic to them, you develop a relationship with them, and then all of a sudden you start to get inbound interest, and you can go to a Workday or you go to UKG or ISIMS and say, look, we're starting to see a lot of interest. I just wanted to let you, because you're a really good partner. That can be a catalyst to an M&A process.
Thank you.
You got it. All right, so here's multiples. We do track ones that are bigger multiples, and they're still happening, right? The IntelliHR deal was small from a revenue perspective, but that had traded at about 11 times. TextKernel, which we all know, got acquired by Bullhorn. That was a 6 times revenue multiple. So decent revenue multiples are still out there. And then with regards to the Monster Career Builder merger, both of those companies had struggled, and they're having a hard time competing with ZipRecruiter, and they're looking to create some economies of scale in order to be more competitive. And job boards is tough, and job boards are not terribly differentiated these days. And there's a lot of new technologies that are coming out that are making it tougher and tougher and tougher for guys like Career Builder and Monster to compete. Now, whether or not this makes sense, I don't know. back in the day, Montgomery Securities and I can't remember the other group. It was the same type of situation. They were older firms. They were both struggling, and they merged. And I think somebody described it as two drunks leaning together for support. And so I don't know if Monster Career Builder is the same thing. Might be, but it was clearly a look. Both are having a hard time struggling. If we can build them together, create some economies of scale, create something that ideally can compete with a ZipRecruiter, maybe there's a win there for both companies, because I think both of them were having a hard time finding a win on their own. All right, and then on the venture side, we do track venture capital flows into the HR tech space. I mean, you can see down from obviously the highs in 2021, but 2023 was a year of really dropping investments, both in terms of dollar value, but also in terms of deals, with the low point coming in Q4 23, Q1 24, but bumping back up again in Q2. And where do we see all the deals happening, right? It is core human capital management and some talent management as well. Not a ton in talent acquisition, but here's an AI-based one, and Hippocratic AI. Nomad Health is focused on the health space, Confetti, Workweek. So deals still happening, but most of that money is flowing into need to have versus nice to have. And then the last section here, we link to our sources because we find that it's helpful for those folks interested to read the stuff that we're reading. And that's it for me. I am happy to entertain any questions that anybody has. Oh, I will also say, just as a reminder, I'm happy to share this report. I'm happy to have conversations with folks who are interested in having conversations. We distribute this quarterly. This actually hasn't gone out yet. We did a redesign, and so I've been working through that. It'll probably go out on Monday. So again, you can hit me up on LinkedIn or shoot me an email, and I am more than happy to share my report.
Lovely.
If
But
you're
wait,
but wait, there's more. If you're going to be at HR Tech or if you're going to be at RecFest, shoot me a note. It'd be great to get together.
It was a really good session, Alan. Thank you. Appreciate that. I can serve as a reference. I talk to Alan often, and I recommend you do too.
Thank you. Thanks, Lori.
that's great. I guess one of the things that came to my mind is certainly with the market starting to pick back up from the investor side, and you mentioned it, a lot of it tends to be going into core now. I mean, they're up to Series F, I think the first one was. For earlier stage companies that need your help guiding them through the market,
Yep.
How would they know if they're ready for your help? I mean, what's your kind of, where can you start helping somebody, right? How early?
That's a great question. So there's when we start helping people, and then when we get officially engaged, right? So we're looking to get officially engaged with companies that are sort of 5 million ARR plus, sort of midway between 5 and 10, with line of sight to 10, with good growth, with decent retention metrics, and approaching cash flow positive. That's a ICP client for us. But I talk to earlier stage companies all the time. And I am happy to talk to earlier stage companies and provide thoughts, review decks, talk about the market, talk about valuations, review financial models, because it's a good investment for me to make, right? Because it helps me stay closer to the space and find out what's coming up, right? What are the new technologies? And also, it's a good investment for me because smaller emerging growth technology becomes larger emerging growth technology companies. And my hope is that if I'm helpful along the way, that my investment will yield me clients. And so it's not 100% altruistic, but I'm always happy to help because I think I can make a difference and I can provide good guidance. I can feed my pipeline by being a good actor, but also I like it. I enjoy having conversations with founders. I have a tremendous amount of respect for founders who said, I'm going to build something new. And for me, it's a lot of fun. So I will take anybody's call, and I'm always happy to help.
Wonderful. Well, the question that just popped up, thank you, Encore, for that.
Yep.
Any notable investments in the frontline worker space?
Yeah, I do. I don't know of any investments that are coming down the pipe right now, but there are interesting companies out there that are startup companies that are raising money or have raised money around the frontline worker space and digitizing something that was historically punch cards. And it's super important because frontline workers are critical workers. And so the ability to create efficiencies, add culture aspects, things like that, I think is something that are big drivers of that market. Certainly don't know of who's raising money today, but do expect that's an area of continued focus.
Before we get to the other question, real quick, Encore, I think what I'm seeing also is a lot of movement in the partner side. And if you look at the bigger players like SIP, UKG, and so forth, even though they already have some solutions in that kind of frontline worker side or hourly side, there tends to be a lot more interest in diversifying that, particularly based on geography or vertical niche, industry, et cetera. So if you haven't already pursued a full, partnership, let's say, expedition into that world, that now's a good time to do that, especially because different ways they can help fund your operation. Although Workday and others have a venture fund, usually it's through other ways to participate in their events and things like that, where you can save some money but still get that exposure and get the leverage into the client base of those partners. So keep that in mind as well until the sun comes out for you on that side. And Alan, the other question was, corporate e-learning market.
Yeah.
Where do you see the growth drivers?
And I think a lot of that is skilling. I think people have come to the realization that to grow within an organizations have not historically been set up to be able to leverage the talent that they have, move it through the organization, right? And because they haven't been set up, you see things like talent marketplaces within an organization to try and foster the talent that you have, and seeing skills as well. And so I think a lot of what you're seeing in corporate e-learning is upskilling, teaching the skills to the existing workers to help fill critical roles in the organization so that you don't have to go out and hire somebody new to do something that you can train somebody to do. And if you train somebody to do it, your retention is going to be much greater because they're already within the organization. Hiring somebody new is expensive. Not everybody works out. If you can train the person that's a good employee within your organization, you can fill those critical roles. It's much cheaper to do that, and you have much less churn. So I think that's one of the big drivers for e-learning.
Thank you very much. Alan, I think we'll wrap here so we can get ready, clear the seats for the next group come in. But thank you so much for the market update. It was fascinating. For those that are members, we'll have this available soon, and non-members will get that on our YouTube channel within a week or so after members get access. So thank you, Alan. Again, everybody reach out to Alan or thinking about exiting, which hopefully you all are. He'll help guide you through the journeys.
Good to see you. Thanks, Gordon.
Special thanks to our presenter, Alan Bourne, one of the founding members of the HR Tech Alliance's community platform. We truly appreciate our subscribing corporate members who provide the primary funding that powers our community platform and empowers our mission.